Hello, everybody. Welcome, everybody, to our second general meeting of the Investment Society. Really glad to see everybody again and a couple new faces here and there. Yeah. Okay, we're going to go ahead and start our general meeting. So, our agenda today, we have quite some unique items going on. We're going to have an internship spotlight from one of our MDs here, Andrew Hernandez, who has some great experience over the past few summers. And I will start this meeting with our quote for the week and our outperforming moments. So the quote for this week is from Ralph Waldo Emerson. And the quote is, "The desire of gold is not for gold. It is for the means of freedom and benefit." This quote can go up to your own interpretation, but for me, I like this quote because we're not chasing money for the money itself. It provides certain values, right? With money, you have special freedom to do certain things one wouldn't be able to do without money, correct? And I'm actually currently reading a book. It's called Psychology of Money. It's a really good recommendation for y'all if you haven't already read it. But they discuss a little bit about this, of what the money itself provides as to freedom and the benefits of it. And now for outperforming moments of the week. Last week I mentioned what outperforming moments are. They could be as little and big as an outperforming moment for the week. Does anybody have something they'd like to share? Any outperforming moments here? Left, right side? Anybody? Yes, Anthony. Nice, that's good. Round of applause for Anthony there. Outperforming moment for sure. Getting ahead of the game, get that draft in. Okay. Anybody else? One more outperforming moment for the week. Anything successful happening? Anybody getting job interviews? It's the fall. It's the peak. Yes. That's a huge accomplishment. Good job. Round of applause. Nice job. And what was your name? I'm sorry? What was your name? Luis. Congrats on that. Okay. Thank you, Luis, for sharing. Oh, sorry. Yes. Who else? Yes. Nice. Congrats. Another round of applause. Good job. And what was your name, sir? What was your name? Ferris? Thank you for sharing, Ferris. Congrats. Good outperforming moment. Oh, one more. Oh, wow. Yes. Nice. Another round of applause. Good stuff. And what was your name? Philip? Okay, Philly. Nice. Nice job, Philly. Thank you for sharing as well. Okay, we'll go ahead and move on here now. And to our internship spotlight here from our MDs. I'll pass it on to Andrew. Thank you.
All right, thanks, guys. You may remember me from last week. My name is Andrew Hernandez, and I do have a few internship experiences over the years. I guess before I jump into it, just notice how small that time frame is. It is literally the course of 3 years, so don't be discouraged that you can't get something anytime soon, because I really went from having 0 experiences and nothing on my resume to what my resume looks like today. So it's a lot of exciting stuff, and hope you follow my path. So my first one here, a maybe slightly less attractive haircut and smaller version of myself in 2020, was working at Origin Bank, working in the residential mortgage department. That's the outside of the office there. Just a small branch, just basically working on, like I said, residential mortgages. And the interesting part about that experience was that it was right in the hill of COVID, that first big wave of COVID that hit. So what did that mean for the economy? At the time, that means that the interest rates were extremely low, right? So people were being able to pull out their mortgages at extremely cheap. A lot of people were buying houses at a extremely fast rate, and for that reason, our bank was flooded with loan applications. I probably seemed a little more important for the bank at that time than usual. As you could tell, I was in an office. And the significance there is I was 20 years old with 0 experience and had my own office. If you know anything about the finance industry, is if you are under the age of, let's just say 27, you will be in a cubicle, right? You do not deserve a window or a seat with cabinets all around you. None of that. So definitely was a testament to the times. Definitely a unique experience, but did learn a lot. Moving on is about a year later, right? Had a few more experiences under my belt. I struck an internship offer with Nubian Real Estate. Just to give some background, they are the asset management arm of TIAA. So that is like one of the largest owners of real estate, but TIAA is probably like the largest retirement plan holder in the United States right now. So all that retirement money, all that life insurance goes straight into this asset management firm at, I believe, $1.1 trillion in assets under management. And it's specifically for real estate, looking at about $130 billion. In the pictures you'll see, so well, let me outline the role first. So I was rotating between acquisitions and asset management. Just to outline what that is, basically acquisitions is you're going out and purchasing real estate. You're trading the equity in real estate, whereas asset management is you're producing the cash flows that the real estate holds, right? I was rotating between the two this time around. Part of that meant I go out to these properties and help lease them up after I do purchase them. One in particular, as you'll see on the top right here, is you'll see an empty floor plate. Nothing that goes there yet. It actually looks a lot nicer than a traditional empty floor plate. But that is actually in the belly of this building that you'll see in the middle right here. That is the fun fact. Well, I'll say the name of this building, and also the fun fact about it is that it is called the Can of Ham. And I guess it does look a bit like a giant can of ham. The funny thing about this can is that it is worth 350 million pounds. That is pounds of the currency, not pounds weight. I don't know how much it weighs, but at the time that was roughly $430 million. So if I did anything that summer, I worked on a $430 million can of ham. Definitely funny stuff. But producing the cash flows there, working on the deal, a lot of fun work. On top of that, you'll see that kind of partially developed building on the very right there. That will be, the largest building in the city of London, right? Something like 6 million square feet. So just to put that in perspective, that is almost every single one of the buildings on campus all together stacked, right? So a huge building, right? There's going to be offices, apartments, condos, retail, a bowling alley, a theater, all in the same place. A grocery store. You could literally get away with not leaving this building your whole life. So definitely cool stuff there. So did touch a little bit of development. And again, a slightly younger version of myself standing in front of the office. Fun fact there is, I don't know if any of you guys have seen the show Industry. That building is where the show was filmed. So that is my claim to fame as of right now. This last summer, I was specifically working in asset management. So no deals this time, just producing cash flows for a company called LaSalle Investment Management, right? That is the investment management arm for JLL, for my real estate people in the room. That is probably the second largest brokerage in the world, second to like CBRE, something like that. That was in Chicago. Amazing time to be in the city. Lots to do during the day and at night. A lot of good food, a lot of good music. Definitely recommend going out there if you get the chance, especially if you can get an internship there. This was very management focused. So really what that means is I was executing the strategies that the dealers had laid out for us. And I'm the one that's really going out there and producing the profit from these buildings and contributing to the company's bottom line. So what does that mean? That means in this case, another empty floor plate. And this is actually less than a floor plate. This is what we call a shell. It has nothing in it except for a few hanging light bulbs. In that case, that was an empty office building. Of course, office is not performing well. A lot of people are vacating. So our strategy was to renovate the property while we could. And that means sucking everything out, walking over there with the team, and deciding how we're going to make it look pretty. So definitely a lot to learn there as well. And my favorite asset that summer was this very tall, $220 million building called the Optima. From the top, you'll see that's the view from the very top there. That's not me, it's one of my buddies, but definitely had a very cool view. The issue there was that it was 100% leased, right? And if we know anything about real estate, nothing should ever be 100% leased because that means you're not charging enough money, right? And enough money is relative because the average unit in that building, this is let's just say a 2-bedroom unit, went for $6,000 a month. Right? Does that sound cheap? No. You probably get away with maybe $2,000 a month for a 2-bedroom in this neighborhood, right, that we're in right now. But by the numbers, it was cheap, right? People could afford more, and it was, it's a luxury building. You should be able to afford more if you think you deserve to live there. So, definitely cool stuff. It had its own mini golf course inside the building. It also had a basketball court inside the building, a theater, and there's also a daycare, so that whenever you go to work, you can, deposit your kids for the day. Yeah, so definitely more cool stuff. So then this will take me to, the last few months, right? The last few months, I began my interview process. Definitely wasn't easy. There was a lot to be done, but my last little stake in real estate was to interview with a company called Prudential Global Investment Management. Some of you guys may recognize the logo. It is Prudential is the parent company. Same situation. It is the asset management arm, technically investment management arm of Prudential Life Insurance. And I don't have any pictures yet, but at least as far as the interview goes, it was a very unique process. So basically, before the interview even started, right, they asked me to complete a deal. I don't know about you guys, but if you got an email saying, "Can you run a DCF?" And by the way, if you do it right, you may get a spot interview, right? It's a bit intimidating, but it's worth a shot. And I mean, I went forward with it. So, here's a few of the assumptions there on the bottom. Built my model on top, and I guess it looked nice enough for me to get the interview. And in that interview, they asked me everything about the model, make sure I didn't BS, asking for some qualitative aspects that I found interesting about the building. And they revealed to me that the building is actually not real. I did a deal for a fictional building. Definitely fun stuff. I had Alex's help on that too. So hopefully good things will come his way. But why am I saying all this is so that I arrive at the lessons learned, right? Lessons learned. Well, let me start off with why the lesson learned with working at a big company, right? These big companies, yes, they have a really fancy brand name. It looks really good on your resume. But the, I guess, consideration is that they involve a bit of politics, right? There's a lot of different agendas that you have to follow. You have to make certain people happy, and you can't really make everyone happy. So you really have to balance your time and your efforts and, what it takes to, I guess, get as far as you can without upsetting, with upsetting as few people as possible. That's just something typical in that field. Of course, if you work for a smaller company, you don't only have to deal with that. There's only one team, only one manager. But in this case, I was reporting to about 12 different managers, right? I was producing cash flow. Excuse me, that was last summer. This last summer at LaSalle, I was reporting to about 12 managers. So that's one thing to take out. And then my last point here is that you should probably never stop learning, right? So I didn't learn this stuff in class, right? I actually take this class right now, real estate investments, where I do a watered down version of this model, right? So a lot of this involves really going out on your own, talking to the right people, networking, and my piece of advice is to find someone that has already done something in your field, so that way you can sort of use them as a mentor. That's how I did it, and I met those people here in the society. So definitely keep that in mind. There's plenty of resources here in the society that you could benefit from. I definitely recommend going to the classes, going to these meetings every week. You will be surprised how much you learned that people just do not know outside of this room. We're a very special and unique group of people here. So, definitely keep coming out. And, personally, feel free to come up to me at any time and, reach out, ask questions. I'm probably, maybe you're one of the go-to people here for real estate, if that's your thing. And then, of course, come to my class because I'll literally teach you how to do that exactly. So that's what I have today. So thank you, guys. And I'll hand it off to Juan Carlos for this week's Market Outlook.
Hey, what's up, everyone? Today, I'll talk about the market for the last 3 months, what's been happening in relation to all the different indexes, how does inflation and interest rates affect the markets, And then I'll go over how do interest rate affect stocks, then an outlook for the next few weeks, outlook for the next few months, and then we'll talk about the Twitter deal with Elon Musk. So first of all, these are the prices for the S&P 500 and the other indexes at the beginning of the year. So the S&P 500 started at 4,800, the Nasdaq at 16,500, and the Dow Jones at 36,585. So year to date, this is based on Monday. The S&P was down 14%, the Nasdaq 22%, and the Dow Jones 11.50%. A little bit of description of each. The S&P 500 is a stock market index that tracks the performance of 500 of the largest companies listed in US exchanges. And the S&P 500 is also one of the most popular indexes in the whole world. Some of the companies inside the S&P are Apple, Exxon, and Visa. Now, Nasdaq is the second largest stock exchange in the US after the New York Stock Exchange. And some of the biggest tech names are part of the Nasdaq: Apple, Meta, Tesla, and Alphabet. And also, Nasdaq started as the first electronic trading exchange. That's how it began. And lastly, the Dow Jones is another index that tracks the performance of 30 of the largest companies listed in the US. And this tries to track different industries. So that's why we have United Health, JP Morgan, and Microsoft. Now, for some context, for the past 20 years, the biggest year-on-year inflation was 5.6%, which was in July of 2008. And right now, for the past 8 months, we've had inflation going between 7 and 9%, which is not ideal when the Federal Reserve wants to have inflation between 2 and 3%. So what has the Federal Reserve done in regards to interest rates? With inflation, with the intention of lowering inflation, the Federal Reserve began increasing the federal funds rate. So they began with a 25 basis point hike. They saw it didn't work, so the next time they hiked it by 50 basis points. And then in June 2022, the Fed raised the rate by an additional 75 basis points, making it the largest single rate hike since 1994. And then they did it again as inflation is really, really rampant, right? How do interest rates affect stocks? Well, first, when the Fed increases interest rates, costs related to borrowing go up, therefore increasing costs for businesses, which affects bottom lines. And when it affects bottom lines, it affects quarter-on-quarter performance for different stocks, and basically it's not good for companies. Higher rates also mean consumer spending declines, therefore affecting companies' top lines and revenue. When consumer spending declines, it affects companies. That's pretty obvious. Now, this might be a little complex. Additionally, higher interest rates, lower valuations for companies as the discount rate is higher. Well, the discount rate, one of the important parts of the discount rate is the risk-free rate, which is based on the US 10-year Treasury yield. And whenever the 10-year Treasury yield increases, it becomes more, it becomes a better avenue and a safer investment for people. So whenever the risk-free rate increases, valuations for stocks go down. This is important, and that's another reason why interest rates are bad for stocks. And while rates have a delayed effect on the economy, markets feel immediately as therefore we're looking. So even though interest rates won't affect different companies on Q2 of the year or Q1, it starts coming in stronger as year progresses. Now outlook, okay, so this is based on Monday. So a lot of things have changed. On Tuesday, the CPI report came in and it was pretty rough. So this is based on Monday. So for 13 weeks straight, prices at gas stations have gone down. US oil futures closed at 81.94 last Friday, which is the lowest price since January 11th, week before Russia invaded Ukraine, and 34% down since its peak in March. Overall demand for oil has declined since the summer ended, and OPEC, which is the oil producers, Saudi Arabia, Russia, some of them lowered production to potentially increase price, because obviously they want to make more money. So they decrease supply. Now, with commodities coming down, inflation in the CPI was expected to decline. This was based on Monday. Obviously, that didn't happen. And this was what the markets were expecting for the last 4 trading days. All the indexes were going up between 3 and 4%. You can see the NASDAQ, the S&P, and the Dow. With inflation declining, the Fed will most likely increase interest rate by less than 75 basis points, which is good for markets. Now, fast forward to Tuesday, so yesterday. The core CPI, which excludes energy and food prices, increased 6.3% in August from a year earlier, up from 5.9% in both June and July. So the core CPI is another important thing. So one of the most volatile measures of CPI is both food and energy. So core CPI is important to see that other aspects other than food and energy are not going up, but they are going up now, since as we can see, it went up more than both June and July. So this is not good information. This is how the markets reacted. This is on Tuesday, so obviously not good news for anyone. The S&P was down almost 3%, the Nasdaq almost 4%, and the Dow Jones 2.65%. Stocks went down and made a potential 75 basis point hike from the Federal Reserve, further slowing the economy. Now let's talk about Twitter. And this is another thing. This was also made on Monday. Obviously now shareholders approved of Elon Musk taking over, but let's go through the details. Elon Musk offered to pay 44 billion or 54.20 a share for Twitter. Right now, as of September, as of Monday, it was trading for 41.44. However, Musk alleges more than 5% of Twitter accounts are bots, and the 5% is an estimate from Twitter itself. I've seen Elon Musk say 20%, more than 20% of bots, which is not good if anyone wants to make money, right? Musk is trying to back out of the deal, and they're going to court in Delaware. According to Wall Street Journal, early polls indicate shareholders would approve the deal, which we already know it happened. Fund managers who together have a 20% stake in Twitter are poised to approve too. We already know that happened too. It is now in the Delaware's judge to decide whether the deal should proceed or not. Now, if you think the deal will go through, if you were to buy Twitter at 41.44, you would get a return of 31%. Obviously, the Musk is not happy. And that's it. Okay, if you have any questions regarding internship prep, feel free to ask me. Perfecto. And now I'll pass it to Alex with the economic perspective.
Good job, Juan Carlos. That was a good presentation. So today we're talking about the economy. It's just going to be mainly a brief overview of the basic stuff. Might be repetitive for some of you upperclassmen, but I just want to get everyone on the same page. So here we go. So first things first, Federal Reserve System. They're a central bank of the United States. And they have four main functions. Main one is manage inflation. They do this through the Federal Open Market Committee, the FOMC. They set the interest rates by changing the federal funds rate. That's important because I'll get later into that, but that's important because the banks are supposed to keep a reserve requirement, and federal funds rate allows federal funds rate is the interest rate that banks charge on overnight loans, and that affects the whole economy and the interest rates that we get from banks. All right, so they do this to change the monetary policy. If they want to raise interest rates, it's gonna be sorry, I'm getting nervous, guys. It's gonna be if you want to lower interest rates, it's gonna be expansionary monetary policy. And so right now we're seeing a contractionary monetary policy. They're raising interest rates to get money out of the market and decrease the money supply. The next thing is to regulate the banking system. So there's 12 Federal Reserve banks. 12 Federal Reserve banks, and that each of the banks are in different regions of the United States, and they're in charge of the commercial banks in the area. And they're in charge of maintaining the stability of the financial system. What I mean by that is providing stress tests for these banks to make sure they do not go under like the Lehman Brothers, right? So if we're in a period of economic instability, they want to make sure that these banks are able to keep lending money and not go under. Another thing is provide banking services. So they'll make loans out to these banks in case they don't reach the reserve requirement. That's through the discount window. The main objective here for them is to maintain price stability and keep maximum employment. There's two types of monetary policy. There's expansionary monetary policy and contractionary monetary policy. Main premise is expansionary is to help economic growth. So you want to do that by increasing the money supply. The way they do that, they'll buy. I'll explain it in the next slide. But the way they do that is they buy bonds essentially, and when they buy bonds from banks, they increase the money supply. Now the banks have more money to lend, the banks have more money to invest, or the more money to lend to individuals and corporations, and the corporations have more money to invest, and we have money to invest and spend, buy houses and things like that. So that decreases the interest rates and there's more money supply. So the contractionary monetary policy is when you decrease the money supply and increase the interest rates. So they'll sell those bonds or let the bonds roll off, meaning they mature and they don't invest back into bonds. And so, that decreases the money supply and takes money out of the market. So that increases the interest rate, right? So they do this, like I said, they do the monetary policy through 3 different ways, right? They conduct open market operations or adjust reserve requirements or do quantitative easing or quantitative tightening, QE or QT for short. So open market operations is when they buy or sell short-term treasury securities. That just means, they're buying government bonds. So like I said earlier, they buy bonds from banks and banks get more money in the reserves. So that means they can have more money to lend out, more money to lend out to people, more money to invest. So that increases the supply of money in the market. Vice versa, they're in a contractionary environment and they sell these bonds, then banks have less money to invest and less money to loan out to people. So they can also adjust reserve requirements, meaning that if they want to conduct contractionary monetary policy, they will raise the reserve requirement. The reserve requirement, I didn't explain this earlier, but the reserve requirement is just a percentage of their bank's deposits that has to be kept at the Federal Reserve. And so they can raise it if they want to conduct a contractionary monetary policy, right? And if they want less money being sent out to other individuals as loans and whatnot, right? And quantitative easing and quantitative tightening is really a last minute decision. The Fed did this at the start of COVID because they said, they bought a bunch of bonds, short-term treasuries. They bought a bunch of bonds and the interest rates went to 0, but we were still in distress. The economy was not doing good. So they conducted QE, which is just buying mortgage-backed securities and long-term treasuries. And so that's kind of a way to provide more economic growth for the economy, right? And QT is the opposite. It's just taking money out of the circulation, selling these mortgage-backed securities and selling these treasuries. On the right side, you're going to see the past 3 months, they've been engaging in QT. So they've been selling or rolling off 30 billion of treasuries and 17.5 billion of mortgage-backed securities. And as of September 15th, they're going to start doing 60 billion of treasuries and 35 billion of mortgage-backed securities every month. So they're getting pretty aggressive on trying to reduce their balance sheet. Right, this is their balance sheet. Well, this is at the peak. At the peak, they had 5.8 trillion in treasury securities, 2.7 trillion in mortgage-backed securities, 100 billion in loans, and 300 billion in other things. Right, so that equals 8.9 trillion dollars in their balance sheet. It's pretty insane. Just for fun fact, it represents about 40% of GDP. All right, so here's some of the economic reports that are important. These are not all of them. These are some of the ones that I think everyone should kind of know. We got quarterly that comes out quarterly is gross domestic product, and that's it's an important one, especially if you want to know the growth quarter over quarter. Monthly, you got consumer price index, personal consumption expenditure, unemployment rate, purchasing managers index, non-farm payrolls, and housing starts. The gross domestic product. You got the formula there, GDP, everyone probably knows this, easy, right? Consumption plus investment plus government spending and investment, and then net exports. And on the right side, you'll see this picture is the average of what it's been at, kind of, consumption makes up the bulk of GDP. It measures the total market value of all the finished goods produced, during a specific period of time. So the main important things, GDP is important, but the most important thing is GDP growth rate, right? So we want to know, are we growing or are we contracting? This past 2 quarters, have you seen at Q1, we had negative 1.6%. In Q2, we have a negative 0.9% GDP growth rate. So, in technical terms, we are in a recession. Jerome Powell came out, during Q2, GDP growth came out. And he said that, he doesn't believe that we're in this recession because unemployment rate is at all-time lows. Production is near all-time highs. And, we're at all-time highs of job openings as well. So when the economy from that standpoint is looking good. So I guess you can say that we're in a paper recession, not a full-blown recession as some of you might think recession plays out. So here, CPE and PCE, these are two inflation indicators. The PCE, the Fed prefers that one over the CPI. They look at the PCE more, and then here is just going to talk about the differences between the two. So there's 4 differences. First one being formula. So you don't have to know the formula, just know why the formula is different. So first one, consumer price index, is Leigh-Spear's type index formula, and personal consumption expenditure is the Fisher Ideal Index formula. So the way it's different is that the Fisher Ideal Index formula, the PCE accounts for substitution, right? So if, let's say, bread goes up, increases in price, people are going to buy less bread, or they're going to switch to cheaper bread, and PCE accounts for that, and CPI does not. Scope. So scope is just what it considers. So CPI considers just urban consumers, and PCE considers urban consumers, rural consumers, and then also those things purchased on behalf of consumers, like by employers, right, or Medicare, Medicaid. So employers will pay for health benefits for some people, right? So those accounts are on PCE. And there's weights. So this is like based on the surveys that are conducted. So for CPI, they're household surveys. So they're what consumers are buying. And then for PCE, they're business surveys. So they're what businesses are selling. And then there's other, which are just minor differences like seasonal adjustments and whatnot. So I thought this was a little interesting graph here. It's pretty old, but it still plays out still today. So the biggest factor in the difference between CPI and PCE, as you can see, has been over the years from 2007 to 2013 has been weight. Weight has contributed to the biggest difference between CPI and PCE, because usually if you look at these numbers, they don't come out the same, even though they both track inflation. The next one is, so we're going to get into inflation today. Juan Carlos went over this a bit. We had CPI, which is month over month, 0.1%. Forecast was negative 0.1%. And we have core CPI, which Juan Carlos said is, strips out the volatility aspect of food and energy. And that came in at 0.6%, double the forecast of 0.3%. And then you had CPI year over year, which is 8.3%. Beat forecasts, beat forecast at 8%. So it came in higher than expected, which is not a good thing. There's a lot of economists, a lot of analysts expecting for CPI to come in under 8%. And so that's why the markets reacted pretty heavily. That just means that, inflation's probably going to stick around a little longer than expected, right? And that's not a good thing for markets. That means more interest rates increases for a longer period of time. So core CPI, and this one was interesting, 6.3%. Came in higher than forecast, but also higher than previous. We'll see in the next slide why that's important and what have contributed to CPI increasing and core CPI increasing and CPI kind of decreasing from the previous. Right? So on the right side, you're going to see like pretty interesting. The S&P finished the day down negative 4.32%. That is 1.6 trillion, loss for the day, which is pretty insane, right? There we go. Oh, Federal Reserve, I forgot to say this, so they're probably going to raise 75 basis points. I was reading earlier today that the market's starting to anticipate a 36% chance of a 1 percentage point rate increase, which is pretty insane. I don't think they're going to do 1 percentage point. I think they might stick with 75. But that would get the federal funds rate to 3%, or 3% to 3.25%. So here you can see the inflation by item. This has the past 6 months or so, 7 months, month over month, right? So August on the very far right, second to the right, we're gonna have August. It shows that the biggest contributors were medical care services and shelter, as well as transportation and new vehicles were really the bulk of what drove inflation this month, right? Besides food, gas, you can see went down 10.1%, 10.6%, or 10.1% for the month. If you see, we all seen gas prices go down, and I'm happy about that. I hope you guys are happy about that too. So, but yeah, so that's why, you know, as we saw previously, core went up. Core strips out the food and energy. All right, so we'd assume that shelter, which went up 0.7% month over month, was shelter and medical care services were big drivers in core CPI. So that it's also not a good thing, right? Because shelter is rents, right? So rents last 12 months. So that means, you know, longer term inflation for a longer period of time, right? So that's not a good thing. So unemployment rate came out 2 weeks ago, I think. So it measures, you know, it's U3. We use a measure of U3. That's what's posted, and that measures just the amount of unemployed people who are willing and available to work within the past like 4 months, right? So it came out. Unemployment rate was 3% this month. Previous month was 3.5%, and that's, you know, it's not a big difference, but if we continue to see an increase in unemployment rate, that, you know, that shows that the economy is finally slowing down, which is a good thing, right? I mean, it's sad to say, but it's a good thing. People need to lose their jobs to dampen demand. I know it's bad to say, but as an economist point of view, it is a good thing, but a bad thing. It is a good thing, but a bad thing. So yeah, I mean, we need to keep an eye on that. I'll probably keep on posting that every month just to make sure that, you know, see where the unemployment rate is going. That's all for me today. Guys, if you guys have any questions, please let me know. Come down here and ask after the meeting.
Hello, y'all. So this week we're going to do a crash course into M&A. So in case anyone who hasn't taken any high-level finance classes, a lot of business classes, maybe you're outside the business major, not really sure all the different types of M&A deals. And so that's what we're going to be discussing. So first off, the difference between mergers and acquisitions. A merger is when a bigger company, a merger is when two roughly similar sized companies come together. And so an example of this would be Exxon and Mobil. Both were very large oil companies in 1999, and there was a period of consolidation during that time. And so as their competitors were all getting bigger, they decided to come together and get bigger as well in order to stay competitive. And then an acquisition is a larger company acquiring a smaller company. And so an example of this would be Amazon buying iRobot this summer. You may not really know what iRobot does, but they own Roomba. So Roomba's a bit more popular name. And so as you can see, Amazon acquired iRobot for $1.7 billion, and they stayed the same. Like, nothing happened to Amazon. Amazon's huge. This was just a couple of dollars out of their wallet, basically. So some cumulative values of M&A deals globally. As you can see, it was kind of going up slowly throughout the decade, and then it shot way up in 2021. There was a lot of money being flown around, and then now it's actually gone down quite a bit as the economy is doing a bit worse. Not quite sure what's going to happen with that, and so companies are a bit wary to buy and merge with other companies currently. And so you have the four main types of M&A deal relationships. There's the horizontal, the vertical M&A, congeneric, and conglomerate. Our example company during this is going to be the Investment Society Incorporated. They sell one product. It's a black polo shirt available after general meetings, $25 for non-paying due members, $20 for paying due members. So first is the horizontal deal. Horizontal is when two firms that are selling a similar product or service combine. So an example of this, there's two types of horizontal deals. First is the competing ones. So an example of that is Exxon and Mobil again. But then there's also the non-competing firms, which is like Carl's Jr. and Hardee's. So Carl's Jr. was on the West Coast, Hardee's was on the East Coast. So they weren't really competing with each other. But when they came together, they were a more complete company. Some advantages to a horizontal deal are going to be an increased market share, reduced competition, advantages of economies of scale, resources, skills, and tech sharing, and then increased synergy. If you don't really know what synergy means, it's whenever two companies do more together than they would separate. So 1 + 1 = 3. The 1 + 1 = 3 is essentially like, it's what synergy is. You guys get it, I hope. An example company, so the investment society, again, our horizontal deal is going to be, we're going to merge with the Business Student Council Limited and the Investment Society Incorporated. We both sell shirts, so we're going to increase market share, reduce the competition, as we're the only business orgs that sell shirts that I know of. I know the Statistical Society has some shirts as well. And then some take advantages of economies of scale. We're buying more shirts together so we can have a lower price whenever we purchase the shirts. And then have some synergy together. Maybe their people are better at some things and our people are better at other things. Great organization. You guys should check them out. All right. So next is the vertical M&A deals. A vertical deal is when two firms that are on different parts of the value chain come together. So an example, the definition of value chain is the full range of activities and services needed to create a product or service. So example of a value chain would be from raw goods to manufacturer to distributor to retailer. And so the advantages of a vertical deal are to reduce costs. So then you can either lower your price and so you get more market share, or to get more profit and so you're more profitable. And then you can have some supply chain stability, which has been a big issue recently. I don't know if any of you guys have known, but we've had some very large supply chain issues. So if you own the company that is manufacturing, for example, your computer chips, you know that you're going to be able to one to get them first. And you're also going to know that your computer chips are of high quality because you are also owning the company that's making them. And so hopefully you would make them high quality. And then also, again, sharing resources, skills, and tech and increase synergy. So an example of a vertical deal for our company would be the Investment Society acquires the Black Polo Manufacturing LLC. Pretty straightforward. So a congeneric M&A deal is when two companies sell related products or services combined. So advantages to a congeneric deal is increased market share again, diversification. So hopefully the products you're selling, even though they're related, maybe if the economy goes down, they'll also purchase the other products. And if your products aren't doing as well, you'll have some diversification there. And then provide access to new customers. Hopefully the customers that they have, they'll share with you, and the customers that you have, you'll share with them. Maybe do like a bundle deal. And so also provide synergy again. An example company congeneric deal would be us coming together with the UTSA Stats Club. They don't actually have hats, but we're going to assume they have hats. And so whenever we're selling our polos as a joint company, we can also sell out hats, and our customers that acquire polos would also sometimes like hats. Great organization. Again, president is actually in the room. Hello, Alex. All right. And then the conglomerate M&A deals. A conglomerate M&A deal is when two non-related firms combine. A couple examples would be Amazon acquiring Whole Foods, Facebook acquiring Oculus. The advantages of a conglomerate deal is diversification, hopefully into higher growth. So that maybe not have been the case with Amazon and Whole Foods, but it definitely was maybe with Facebook and Oculus, as they're trying to kind of shift their company towards VR. And so also increase synergy again, hopefully, especially with the growth company that you're acquiring that's smaller. If they're having monetary issues, you can provide that as the bigger company. So our example for the investment society is going to be the investment society acquiring Gardena. Anyone know what Gardena sells, or Gardena? They sell essentially Roomba for your lawn. It's an autonomous lawn mowing robot. So we're not related with them at all, but hopefully they have higher growth than our T-shirt chills. So a couple modern deal types that they don't quite fit into 4 categories. The first one is acqui-hiring. So that would be whenever a firm acquires a different company just for its human resources. And so this is typically like a startup company that's about to go under. It actually is good for both. Originally, you'd think that doesn't sound so good, but if you're about to lose your job, if Amazon purchases the company you're working for, at least you get to keep your job. Maybe you're not working for the company you want to work for anymore, but you get to keep the job. And then SPACs. SPACs is whenever a publicly traded shell company, so a company that's just money, has no operations or anything, goes out and acquires or combines with a private company in order to take the private company public. Oftentimes, the SPAC is being ran by a famous business person who has some kind of tech industry knowledge that the company they acquire, they'll be able to not only take them public, but have better leadership. And so also we have some reasons that some CEOs wanted to main strategic drivers for mergers and acquisitions. Number one was increasing operational capacity, so that could be horizontal or vertical. And then to strengthen the ESG rating, which is essentially like the sustainability outlook on the company. Some people invest only in high ESG rating companies. So if you increase your ESG rating, maybe some more companies would be interested in you. And then some bolt-on acquisitions. This would be to increase market share. And then the acquisition of technology, talent, and production would also include that higher acqui-hire I was talking about, and then enable major geographic expansion. So here's my LinkedIn. Go ahead, you can connect with me on there. And yeah. Next up is a sweet spot.
Thank you, Waylon. Real quick before we move on to Professor Sweet. Okay, perfect. It updated. Please scan this QR code for attendance. Those on Zoom can also scan the QR code, but this QR code is for attendance, as well as our 2 gift cards we'll be giving away at the end of the meeting shortly. 2 gift cards for $25 value. Sadly, those on Zoom will not be able to eligible to win them this meeting, but those in person, you have that chance if you have paid your dues so far. Now, Professor Sweet.
Y'all got it? The scan? Y'all are fast scanners. Y'all ready? Y'all get the code? Y'all need it back?
Yeah.
Y'all need it one last time? You gotta be fast. All right. Just real quickly on the classes and sectors, we're gonna start them September 26th. So we need 1 more week to get scheduled. This is somewhere where we are today, although I missed a couple of them. If you email me to do one and I don't have it up here, then email me again because I'm having trouble keeping track. So our sectors, we have 5 sectors, which is what we want. We're still coordinating that. If you want to do a sector, we'd like for you to team up with someone, which will really help because we want to do them really professionally. So it gives you 2 people to help. We'll get the schedule. If you do the sector as an attendee, as a student, you'll learn how to screen for stocks, how to do capital IQ, how to do Bloomberg, how to use Excel. So you'll get 4 things you can put on your resume just by going 45 minutes a week to a meeting. The classes, we're still working on those, but we should have a fact exam review, commercial real estate, as Andrew mentioned, an Excel class, a Tableau class. I might do a wealth management and basics trading class. That was real popular in the past, but it was taught by a former student. So if I do it, it may not be well attended because y'all don't want to listen to another professor. But if anyone wants to teach something and want to tag up with me and we can work that out, we can certainly do that. But how do you set up a brokerage account? How do you trade? How do you figure out what stocks to buy? asset allocation, those kind of things. There are things you can do yourself on self-study, Bloomberg Market Concepts, Capital IQ. Anthony found a really, really good Capital IQ training module that you can do yourself very easily. I went to his class last year. He just showed the video, which is an excellent way to do the class. And this summer, I converted a lot of my Bloomberg sheets to Capital IQ Excel spreadsheets, just so I can learn them both. So we got to get them both on your resume. I used to think you got to learn Bloomberg. And as I've been visiting alums, about half of them are using Capital IQ, half of them are using Bloomberg. So you really do need to learn them both. And in Python, you can teach yourself, go to Code Academy, those type of things. So there's things you can do to teach yourself. You don't need a professor. You don't have to wait for a professor to learn something. As far as the Costa Rica trip, I'm still working through the paperwork on that. Right now, we've got 4 men and 2 women. So it'd be great we get 2 more women to sign up. But it doesn't have to be if any men. There's more men in the room than women, but it'd be great to have 4 men, 4 women to go. 8 is about all we can do because airfare is so high right now, unless jet fuel prices drop here sometime soon. We'll see. I need to finalize that probably by the end of September so I can finalize everything and buy tickets in October. So what are your biggest questions on that? Any classes that interest you? Any sectors that interest you there? So, all right, we'll see. Well, maybe, hopefully someone will help me because I don't think it's going to go well if I'm the one who does it, but anyway. All right. Yeah, I attended all the classes last semester. I learned a lot last semester. I'm sitting there going, in the Excel classes, well, I didn't know you could do that. It's like, I built a spreadsheet 5 years ago. If I knew you could do that, I would have built it much differently. Tableau, I gave Waylon my spreadsheet from my charity, and I said, can you Tableau this? And we got it to work kind of good. I mean, I didn't have the spreadsheet set up very well, but very interesting. I learned a lot in every class. All right, what I want to talk, we're talking so much about inflation, and you've heard it from 2 of our presenters tonight because it's just so central. So how does inflation impact directly the stock market? So what I did is I put over here the PE ratio. The PE ratio is how much you pay for $1 of earnings. So if a PE ratio is 20, you're spending $20 for $1 of earnings. If earnings don't change, it's going to take you 20 years to get your money back, but we expect earnings to grow. So you spend $20 a day, you get $1 back. Next year, you get $1.10, $1.20. Over time, you get your money back. If the PE ratio is 10, that sounds really, really good. You're spending $10 for $1 of earnings, you're going to get your money back pretty quick. I haven't looked at like a firm like Macy's in a while. The last time I looked at Macy's, its PE ratio was like 5. So they could just do what they're doing today, and in 5 years, you get your money back. What's the market telling you? They're not going to do what they're doing today. They're going to decline. So what I did here is show you there's a relationship. You see with this orange line, when inflation is low, PE ratios are high. When inflation is high, PE ratios are low, generally. So when I graduated from college and high school, this is where we were. PE ratios were 8 and 9. Why? Because inflation was so ridiculously high. And then you have really low inflation. When you have really low inflation, PE ratios like 20, 22, 23, 24, pretty high. Up here, that's the .com. 1998, 1999. Oh man, I'm scared to even ask. Were y'all alive then? Y'all weren't even alive then. I used to in my class to say, remember when Jimmy Carter was president? I've learned not to say that anymore. But now I can't even talk about the .com. God, my word. Okay, so I'm ancient. Okay, so the .com 98, 99 stock market was extremely expensive, and you could really, even though inflation was pretty low, PE ratios are like at 30, pretty high. Where are we today? It's all these green dots. These green dots are 2020, 2022. What do we have? We have really high inflation and we have really high PE ratios. Here's where we are this last month, August. Our PE ratio was 19.3. Based on history, our PE ratio should be at this inflation level, should be like 13. Someone do the math. That's like, what, a 40% drop? So either inflation's got to come down, which we just been told it's not, or the stock market's got to crash. It has crashed. You can tell, right? You can see how it's coming down, coming down, but it hasn't come down much. Now, is it going to crash another 30%? I think it will unless it doesn't. So that's my forecast. But there are people out there like Jeremy Grantham. He's talking about a 40, 50% drop. There are people out there saying that. It really does come down to what you think the Fed's going to do with inflation. If they raise rates 100 basis points next week, is that really going to slow inflation down? You know, we've got a lot of things going on that seem temporary, like the war in Ukraine. You got supply disruptions, but there's other things that don't seem so temporary. I think that core CPI and PCE, those numbers going up, that makes you a little bit nervous. So here's where we are. Here's where we should be at these inflation levels. If inflation gets back down to normal, we'd have to have an inflation rate of like 1 or 2% for the current PE ratios to make sense. So a little scary. How much time do I have? Okay, I'm going to stop there because I want to talk about growth versus value stocks. I'll stop there, so I'll give Anna 2 minutes. So, all right, thanks, guys.
Thank you, Professor Sweet. Hope everybody saw the spreadsheet there on Zoom. And here I'll reiterate the classes and sectors. Please email Sweet if you're interested in that. They will start soon. I'm hoping to teach a sector. Sweet mentioned that. Right now I was working on the raffle. Thank you all for being honest. I had to shuffle that several times because a lot of y'all have not paid your dues yet. So missed gift card opportunities there. But let me continue here for the society updates. How many of y'all love to wear polos every day, 24/7? Okay, exactly. Not many, right? Who likes polos? We're having a t-shirt design competition here. The designs are due, what is that, next week already. And next week, we're hopefully gonna vote which design looks the best for our investment society shirts to be sold. And we'll hopefully get them delivered throughout the semester and we'll be repping the investment society. So please email us, let me know, contact any MDs if you're interested in this. If you're not too artsy or crafty, whatever, you can't draw, we can work something out and maybe we can get a good design going. I'll pass it on to our social chair here to discuss possible social events.
By your reactions, I hope you guys like the first picture. So social event, I really wanted to keep it not very costly for you guys. So I wanted to hold a game event, preferably online. You know, we can be playing Among Us, Scribbly.io, so basically Pictionary. I had a lot of fun playing that. That's a pretty fun game to play. As well as for the more sweaty players, I guess. You know, we got League of Legends, as well as, you know, feel free to request any type of game you want to play, you know, on the Discord. I know we had another social event idea. I don't know who requested it, a potluck. That sounds like very interesting to do. You know, bring types of food, maybe for closer in the Thanksgiving time. Market Watch competition is open. It opens 6 p.m. today. You know, make sure to sign up. The link should be on the Discord, so make sure to join that for the Market Watch competition. Remember, if you get top 3, you win a good gift card, good prize. Polos. Who likes polos? I like a polo. I like wearing polos. We all love wearing polos. I don't know if you were in middle school, uniforms. We got $25 for if you have not paid your dues, but if you are a member and have paid your dues, they're $20. So at a very good price. Thank you.
Thank you, Juan. I did not know he was gonna go through all the slides. So does anyone here play League? Come on, I know some of y'all play. Come on. Okay, I play League. I'm not the best, but I play League. Scribble, Among Us, that was super hype back then. Yeah. Okay, cool. So Juan will be reaching out on Discord later, give some more details if y'all are interested in. So pretty cheap for everybody to join. Please join the Market Watch competition. I think I already placed some trades, so I'm ahead of the game. Yeah. And we will be selling polos right now. Meet with us after. So the gift cards, we have 2 gift cards we're giving away. You do have to be present here. The first gift card goes to, little drum roll, Alex Martinez. Where's Alex? Raise your hand. I cannot see. Okay, congrats. You won our first gift card of the meetings here. And the second gift card goes to Filiberto Doñas. Sorry. Okay. Filiberto. Yes. Congrats. You win the other gift card. So the gift card winners, please meet with me here after the meeting real quick to get your contact info and so we could email you that gift card. And before everybody heads out, scan our QR code. That's our LinkedIn link tree where it has all our socials, the Market Watch competition, and everything going on. Stay up to date with y'all. Hope everybody has a great night. Thank you for being here. See you in the next meeting, everybody.